Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. I'll provide just a little bit of a overview and background on TaxConnex and Jeff and myself. And we've worked together for probably too long. I think 20 years is probably about right. But Jeff comes at this from a few different perspectives, having been an auditor, having worked in industry, and then being a consultant as well. Personally, I've been in the sales tax industry, just been in the industry for about 30 years or so. I've been in sales tax for about 25 years, last 15 here at TaxConnex. Spent about 5 years at Thomson Reuters, and the previous 5 years from prior to TR in another sales tax consulting company as well. So I think combined, we've got a good bit of experience here talking about, TaxConnex in general. What we do is we're very focused in the sales tax industry. And I suspect everyone on the presentation today has something to do with sales tax, and you recognize how crazy and chaotic sales tax can be. So we're hopefully here to help you address and conquer some of those challenges that you have from a sales tax perspective. And the business itself, we really operate through a couple of different, let's say, service offerings. One would be our consulting and compliance group, where a lot of times we're just helping companies figure out, what are we supposed to do from a sales tax perspective? And what type of exposure and risk do I have? How do I mitigate that? How do I get into compliance? So we help companies from that perspective. We help companies with the tax calculation and determination, so making sure the right tax gets calculated or placed on the invoice or within the shopping cart, and then also helping them from a compliance perspective in terms of the preparation and filing of the returns, remitting the tax payments to the jurisdictions. So that's my brief overview of the business itself. In terms of the agenda here today, we're going to kind of mix this up maybe a little bit. Some of this is going to be, as Liz mentioned, a little bit of a review of some basic sales tax concepts and principles. You see nexus, taxability, determining exposure, and implementing a tax compliance plan. So really kind of helping companies figure out, how do we get into compliance? Maybe you're in the audience. Maybe you're thinking, I've got to have something in place for 2025. I think what we're going to describe is going to really help put a process in place for 2025. And then we also have some updates and some thoughts on some changes that have happened and are about to happen as we move into the new year. All right, Jeff, I'll turn it over to you.
Thanks, Brian. As Brian said, a lot of our conversations tend to start with a nexus discussion. And in some cases, or in a lot of cases, it might seem repetitive. We include a narrative around nexus almost always. And believe it or not, it is a sort of challenge for a lot of our clients to stay abreast of nexus requirements, at least the thresholds that they're required to adhere to in their own businesses. So we always find it advantageous to kind of just summarize and talk a little bit to the nexus problem or the challenge as it relates to sales tax. And essentially, for those of you that aren't necessarily intimate with the word nexus or familiar with the terminology, nexus is simply whether or not you've established enough of a connection with a jurisdiction such that that jurisdiction can impose its taxing authority on your company. Without nexus, if I don't have a presence in the state or in the local jurisdiction, that jurisdiction doesn't have authority to require me to comply with their sales and use tax laws. And when we think about sales tax nexus specifically, we historically have viewed it as a physical presence test, meaning you had an office in the state, you had employees in the state, you had inventory in the state. Those were sort of the standards by which we measured establishment of nexus over the course of time. And when we look at that physical presence attribute, we go back to 1967 and some court cases during that period of time that outlined these sort of standards. And beyond those three standards that we talk about, the employees, the inventory, and an office, there are other factors that can contribute to physical presence. That can be employees that are traveling into the state to solicit on your behalf. It could be agents that are participating in provisioning of services on your behalf to customers located in that state. Any activity that represents a physical presence that enables you to establish or maintain a market in a state is something that's likely to trigger nexus. And so you just want to be knowledgeable and comfortable with those standards. When you look at the map on this particular slide, you'll see some states that are grayed out, and I'll just talk to those briefly here before we talk about economic nexus. There are 5 states that don't impose a state-level sales tax, or at least a general sales tax, those being Delaware, New Hampshire, Montana, Oregon, and then Alaska. Alaska is not reflected as a gray state on here, primarily because the cities in Alaska, a number of them at least, do have city-administered sales tax implications. So they actually have their own ordinances and their own administration of sales tax at that city level within the state. So as we evolved in terms of the economy and the marketplace over the course of several decades, there started to be a gap between those people that represented brick and mortar activities in a particular state versus companies that were operating in more of a cloud-based economy. And the states were feeling disenfranchised, or at least the companies based in those states were feeling a little bit disenfranchised because they didn't feel like it was equal playing field between the e-commerce companies and the local brick and mortars. There were a number of evolutions and attempts to try to level that playing field by certain states over the course of about 10 years, beginning in the late 2000s and going into the mid-2015 time frame. Some of those theories which were enacted and legislated just were onerous to taxpayers. An example of which was the Colorado reporting requirement. Colorado basically said if you have more than $10,000 in revenue from sales into our state, despite the fact that you don't have a physical presence, we're going to require you to do 2 things and in order to maintain compliance in our state. One of those things was you had to report to the state at the end of each year all of your sales to all of your customers, listing out your customer base. The other was you had to include on your invoice a statement to your customer indicating they had an obligation to accrue and remit use tax directly to the state. Both of these were very uncomfortable for any vendor, as you might imagine, and they didn't get a lot of traction, even though there was a level of enforcement intended. Eventually, we have South Dakota that comes into this equation and enacts a pure economic nexus standard. And what I mean by a pure economic nexus standard is They said if you have an excess of $100,000 in sales during a given 12-month period, you in essence have a triggered nexus for sales tax purposes and are now obligated to comply with the sales and use tax laws of our state. Interestingly, this particular legislation was challenged after the state asserted nexus against Wayfair, an online retailer, and this was a challenge that was successful by Wayfair. They basically took it up through the courts to the state Supreme Court of South Dakota and were successful. The state Supreme Court ruled this unconstitutional. However, the state of South Dakota then asked the U.S. Supreme Court to hear the case, and in April of 2018, that case was heard by the U.S. Supreme Court, and in I think it was June 18th of 2018, the court ruled 5-4 in favor of the economic nexus standard. And basically, it didn't establish law, but it did establish that the highest court perceived this type of legislation to be acceptable and to pass the Commerce Clause and to be legally viable. So as a result of that decision, all of the states that were watching this case closely started their own legislation, some of which had already enacted or at least staged legislation that was quickly enacted subsequent to that decision. But over the course of the next 2 to 3 years, all of the states came into focus and established their own economic nexus standard. They're all fairly similar. There are kind of two components to it in a lot of states, one being a $100,000 threshold during a 12-month period, the other being a transaction threshold. Now, not all states have the transaction threshold, but a number of them do, and they basically assert that if you have 200 or more transactions during the course of that 12-month period, despite the fact that your revenues might be less than $100,000, you've established economic nexus with the state. And the reason I point that out is we'll talk a little bit towards the end of our presentation today about some of the states who have already repealed that 200 transaction threshold and some states that are getting ready to or have recently repealed that threshold. I will note, I talked about Alaska intentionally earlier in terms of the cities having some city level sales taxes. Those cities almost entirely have conformed to establish their own economic nexus standard and basically have stated that if you have $100,000 in sales into the state of Alaska, you essentially have established nexus with each of those cities that are part of that coalition and now have an obligation to comply with each of those cities. The last thing I'll note is DC. We treat DC, District of Columbia, as a state in terms of sales tax. So DC has their own economic nexus standards, has their own administrative policies and legislation around nexus. So when we talk about nexus, again, it is sort of a precursor to sales taxability. And it's important to distinguish between the two. Just because you have nexus does not mean you have taxability. Doesn't mean you have any tax requirement whatsoever. It only means that you should at least understand your business activities in that state to the degree that you know whether or not you are subject to sales tax and should be compliant in that state. So we tend to look at nexus sort of in its own sort of package and answer that question yes or no. If the answer to the nexus question is no, we don't even talk about this next slide. If the answer to the question is yes, we have established nexus in one or more states, whether it be physically present or economically present, then we need to take a look at our products and services and determine whether or not we have an obligation to comply and register. Now, one of the things I didn't mention on the nexus side, particularly when it comes to economic nexus, is there are some variances across some of the states. There are a few states like California and Texas that have a $500,000 threshold rather than a $100,000 threshold. Mississippi, Alabama have a $250,000 threshold. So there are a few variances out there. What I encourage companies and clients to do is just think of them all as 100,000 and kind of watch your numbers, watch your business model, As you start to exceed 100,000, then you can get more granular as to whether or not that particular state in which you've exceeded that threshold is a state you need to worry about. But there is some variability in that regard. And then similarly, when you get into taxability, you're going to find a whole new world of variability, depending on what your business model encompasses. Taxability is heavily driven by lobbyists that are engaged in various opportunistic discussions with legislatures. And, there's constantly a challenge or a pool in terms of where do we provide benefits from a sales and use tax perspective to enable an economy to function and flourish. So there's a lot of negotiations that happen in that regard. But the net of this is taxability can be vastly different by state. The one thing that is fairly consistent across all the states is that the retail sale of tangible personal property is subject to sales tax. That's a fair statement across all the states except those states that don't impose a sales tax. And in that regard, we're talking about retail sales, meaning sales to end user consumers. So when I go to Home Depot here in the Atlanta, Georgia area and buy anything of tangible personal property, I'm generally expecting there will be tax imposed on that purchase. But as I said earlier, there are a ton of different scenarios, lobbying efforts that can impact that. For example, it might be that everything is taxable in Home Depot except for plants or except for fertilizer. There could be specific carved out exemptions that exist for certain types of products, and we would call those and refer to those as statutory exemptions. They're fairly rare, fairly not something you would experience, but they do exist. The other type of exemption that would exist in this regard is when you're not making a retail sale to an end user. In other words, I'm selling to someone who is in turn going to resell that product at retail or resell it at wholesale. And in those instances, even though tangible personal property is taxable, I can extend to my vendor an exemption certificate. We call that a resale exemption certificate, and affect the taxability of that product and exempt it from sales tax in that particular state. There's a lot of variables along the way when you get into exemptions. We won't go into that in detail today, but just wanted to give you a surface level perspective and picture of that. The more complicated area when we talk about taxability is services. Historically, and the further back you go in time, the less there were of service-oriented industries and businesses, and there were less implications from a sales and use tax perspective on services. Services can encompass such a wide variety of things. There are what we call professional services, and I tend to put those into a bucket of 5. They tend to fall into medical services, accounting services, legal services, architectural services, and engineering services. Those tend to be the components or the industries that states look at when they think of and start to articulate that these are professional services. That being said, there's a whole host of other services that could be categorized or at least called professional services, and those kind of fall into what I would call general consultative or consultative type services. So when you get into the technology industry, and specifically, there's a good bit of this. The services that are engaged by technology businesses can be anything from remote server monitoring to software as a service to integrations, configurations. There's just a whole host of activities that are service-oriented where tangible personal property is not exchanged. And the reality is that this is an ever-growing and ever-challenging environment for companies to manage through because the states are always playing catch-up. So what might not be taxable today as a service, tomorrow might be taxable. And the states are always watching the economy, watching the tax revenues, and looking at where does, the example I would give is 20 years ago when you needed software, you went to Best Buy and you bought it off the shelf and you put that CD into your computer, and you now had software. Then we migrated to downloaded software. So we had login credentials. We could go through the web and download a software application. And now we've evolved to software as a service, where it's a subscription model, and the software is actually resident on an external server, not owned or managed by me, the customer, but merely accessed by me as necessary to perform computations. So just an example of some of the complexities and challenges that are faced by companies out there as they start to expand their business model into other states. They have to take into consideration both nexus and taxability. The last comment I'll make about taxability is around situsing. Situsing is essentially asking the question, where did this transaction occur? What jurisdiction has the authority to impose tax on this particular transaction? And that too can be very complicated, particularly in the services world. As I described earlier, if I walk into Home Depot, I've got a point of sale transaction. It's clear that the situs of that transaction is there at that store. But it can get complicated when I walk up and pay for that item, and then I ask Home Depot to actually deliver it to me to another county and another jurisdiction within the state that has a different tax rate. And maybe even more challenging, maybe I've asked Home Depot to deliver it to another state. I could be located in Charlotte, North Carolina, and I need a specific item that's located in a store in Fort Mill, South Carolina. So I go down and I buy it, and I have them ship it to me in Charlotte. Now I've crossed state lines. Where's the situs of that transaction? So situsing is a real challenge. Most of the states are fairly consistent in their rules. They tend to focus on where does title transfer or where is title deemed to have transfer. But when you get into services, there's not necessarily a title transfer. So in that case, we flip it to where is the benefit of service being received. So these are simply high-level perspectives, challenges, questions that you need to be asking and understanding as your business expands and grows across state lines.
We touched on this a little bit, but looking if there are any consensus on uniformity among the states from an economic nexus transactions perspective. I would say there's enough uniformity to make it confusing, meaning there are a good number of states that are similar, but there are enough that are different that it becomes challenging. And if we're looking specifically at the transaction counts, Jeff mentioned we've got a little bit of an update later on in the presentation on that. But generally speaking, what we're seeing is states are repealing the transaction count thresholds. I think the concept originally of economic nexus wasn't meant to capture small businesses, and that was part of the reasoning for the $100,000 threshold as kind of the minimum standard in the states, is that we really wouldn't force the sales tax obligation on smaller businesses that had minimal revenue. And what we started to see were these states that had transaction count thresholds. A company that might have 200 transactions could, in theory, have $200 in tax, or excuse me, $200 in sales, or $1,000 in sales, or $5,000 in sales. And the economic nexus standards were really never meant, at least in my opinion, to really capture those businesses. So that's where we started to see the repeal of those transaction counts. And we'll talk, as I mentioned, a little bit later in the presentation about that. So unfortunately, very little conformity across the states. So, all right, so Jeff, I think we got the next topic ready to go here.
Okay. So let's kind of take the last two slides that I talked about, nexus and taxability, and get to the place where we go, holy crap, I'm in trouble. And that's sort of the title of this slide, sales tax exposure. This is basically looking at scenarios where you've uncovered the fact that you have had nexus for a number of years, perhaps, And you've also uncovered the fact that the product or services that you've been selling over those periods of time are also taxable. And so you've kind of identified that you are a target for assessment, where a state could easily, or maybe not so easily, assert that you have nexus and then assess you on those taxable transactions that you had during that time when you had nexus. And we find companies in this state fairly often. Our business model is really geared towards small to mid-sized companies and trying to assist them in identifying when and where they have an obligation to comply for sales tax purposes, and then on an ongoing basis, help them manage that compliance. So I, particularly me in my person, spend a good bit of time on sales tax exposure. I'm usually engaged when there's a circumstance that reveals we've got some risk, we've got some underlying tax liabilities, which also can encompass penalties and interest. And we have to do something about that. And the story is usually a little bit different from company to company. Most of the time, the storyline is, look, we had no idea that we had nexus. Had we had an idea that we had nexus, we probably would have looked into the taxability of our products, but we didn't even make it that far. So we've been clueless and just haven't understood the laws to the degree that were necessary. And we also recognize that sales tax is not what people go into business for. You go into business to build products and services that are marketable and useful and beneficial to customers. And along the way, you're hiring employees, you're having to comply with varying districts and state tax laws as well as the federal government. It's a spider web of complexity in terms of where compliance is going to be required. Sales tax a lot of times just falls to the bottom just because we call it an indirect tax, meaning it's really intended to be passed on to the customer, passed on to the end user consumer. And so it's not always a true expense item for businesses, whereas federal income tax and state income tax are direct impacts to the bottom line for businesses. So again, we acknowledge that this particular area doesn't always get the attention that it might deserve. What I tend to convey to companies is, while income tax is definitely a hit to the bottom line, it's a smaller percentage of your overall income because of all the deductions. So it's a percent of percent. When you talk about sales tax, there's kind of two sides to the equation. There's the buy side. Let's say I'm a Home Depot and I'm buying inventory to put on my shelves for sale. That has a tax implication for sales tax purposes. That is a taxable transaction unless you've executed the exemption certificates adequately. So there could be an 8 to 9% impact there. On the flip side, when I make the sale to the customer, there's a transactions tax again, a sales tax again at the 8 to 9% level. So you could be looking at a 16 to 18% tax impact on just one particular type of inventory item if you're not careful and if you don't manage it appropriately. So it can become a magnitude of sort of severity pretty quickly without you realizing it. That being said, there are some ways to go about your business on a go-forward basis. We don't just shut down just because we have a significant sales tax exposure. So we like to look at all the facts and circumstances, and we consider three primary options. And I'm just going to tell you, I consider two primary options because one of these not my favorite. The first and the third are my favorite. The second one I'll spend a little bit of time on because it's not my favorite. So the first course of action is to simply say, okay, I should have, I could have, I would have, but I didn't. I didn't charge any tax in the past, should have charged tax in the past, would have done it if I knew about it, But at this point in time, I have no way to go back and recover that tax from my customers, and I'm stuck. I got to do something because I don't want to continue down this path and create even more exposure for myself. So we might look at just simply registering and managing your compliance prospectively, meaning I'm going to set up a sales tax account with the state. I'm going to start charging tax to my customers. I'm going to collect that tax, file, report, and remit that tax on a periodic basis. In this particular instance, there's kind of two scenarios I think that are worth mentioning. One, we've kind of got a little bullet point. You might decide for financial purposes simply to book an accrual for this exposure, to just recognize it and say, hey, there's some risk here. We want to book it. In the eventuality of an audit by a state, we at least have some financial reserves. We may not have the cash, but we've got the financial impact covered to some degree. So that's one aspect. The other aspect that gives a lot of people heartburn, including myself to some extent, is when you register, when you actually fill out the application to register, there is a question on each application that asks, when did you first have taxable sales in the state, or when did you first start doing business in the state? It's a difficult question to ask if you have all of the prerequisite knowledge of your prior period exposure. That being said, we've been involved in probably tens of thousands of registrations over the last 20 years in our businesses. And the worst thing that can happen that we've experienced is that the state comes in a year later. You've established yourself as a taxpayer. You've now been compliant for a year, and they uncover that you should have been registered 4 years prior to when you actually registered. They're going to assess you tax, and they're going to apply some penalties and interest, and you're going to be considered just a non-filer at that point. We've never seen any state look to pull back the registration application and focus on that one specific question and answer. And I've told this story, the team here in our office hears it too much from me, but about a year ago, we did a webinar. I talk about this sort of thing fairly regularly. The next day, I got an email from the state of Pennsylvania Assistant Secretary of Revenue asking me for a meeting. They said that they had been a party to our webinar the prior day and wanted to talk to us. So I got a little nervous, as you might expect, because I know what I've got the propensity to say on one of these calls. So I went into that conversation with some trepidation. It turned out to be a very valuable conversation. The state simply said, hey, we recognize you guys have influence in the market. You have an opportunity. We'd like to work with you. Are there things we could be doing together or doing better on our side to make it easier and more effective for compliance? And we talked about this specific issue. I told them about this specific sort of proclamation I make, and that is, it's okay to move forward on a prospective basis. I said, the reality is you, the states, are incumbent upon the voluntary aspect of compliance. You're not set up and capable of auditing every company. So you need for companies to come into compliance as quickly and as soon as possible. The worst thing that can happen with a company that has prior period exposures, they bury their head in the sand because they're frightened of the outputs or the outcomes. And the state during that conversation just basically shook their head and said, hey, we get it. We understand. So there's an acceptance to some extent. I'm not telling you it's legally viable. I'm just saying that we just need to be in compliance sooner than later for the betterment of everybody. Another option down that path is to register and file prior period returns. What this looks like is I on that form, I tell the state that I started doing business in October of 2023. And as soon as I submit that form, they're going to initiate notices and require me to file all of those prior period returns. Upon filing all those prior period returns, they're going to automatically assess penalties and interest for the deficiency. So you've got the cost of compliance of going back into those periods, and then you've got the tax implication. And this presumes, all of what I'm saying presumes you haven't charged or collected any tax in the past. You just simply had an obligation to comply. And then you're going to get the penalties and interest on a per return basis. It's a lot of paperwork, it's a lot of time and effort, and it's just expensive. It gives people heartburn. The last option, which is one that is very valuable to a lot of our clients, but not always a necessity, is a voluntary disclosure agreement. We refer to these as VDAs. And there's two primary benefits to the VDA. One is penalty abatement, which I discount as a real benefit, and I'll tell you why in just a second. The other is what's called the limited look-back period, and that's basically the state looking at a business who has not collected tax, but had nexus, let's say 5-6 years ago, and has been transacting taxable business during all those periods. What the states will do under the VDA program is they'll agree to give you the benefit of their general statute of limitations for filers. They'll treat you as if you've been filing regularly all during those periods, and they'll only go back 36 to 48 months on average. There's a few outliers to that, but generally most of the states are 36 to 48 month look back periods. So there's a great deal of benefit in that. I can sort of write off that year 5 and year 6 exposure and risk, but I have to recognize I've got to come out of pocket and pay for the tax in the last 36 to 48 months. And I'm also going to be assessed interest. You got to pay it. And you will be afforded penalty abatement. The reason penalty abatement isn't as attractive to me as a component here is if you did nothing, let's say you chose option 1, registered and filed and complied prospectively. It's my theory and experience that if you were identified and audited, you would be assessed the same amount of tax. Again, the limited look-back period might not apply. So if you have 5th year and 6th year exposure, you're now going to have to pony up for that. And in most cases, it's your first audit. You're likely to get penalty relief, if not penalty waiver. So that's why I don't necessarily value the penalty abatement aspect, although it is automatic, or at least more automatic during that process. I will also add, and I've been iterating this a little bit, the rules change if you've been charging, collecting, and not remitting, and not being registered. All the dialogue you've heard from me changes when you're in that scenario. You cannot collect a dollar and not be obligated to remit that dollar to a state, no matter the VDA program. The VDA program does not cover tax collected. It will afford you the same sort of treatment from a penalty perspective, but even in that case, there are some states that impose a minor penalty if you've collected the tax, like 5 to 10%. So in any case, I think these are what we believe the sort of formal and logical options that exist if you find yourself in that oh crap moment.
So Jeff, while we're talking about VDA, is just a quick question here. Software as a service in the state of Illinois, we know it's not taxable at the state level, but Chicago has that, I believe it's a personal property lease transaction tax, something unusual like that. But are there VDA programs at the city level within Chicago? What are your experiences with that?
Chicago definitely has a VDA program. It's a formal program. It's fairly easy to execute within. They're very communicative. They're excited when you want to engage in the program. Chicago is not necessarily one of my favorite cities in that they're not very flexible. That being said, and so when I say they're not flexible, they're not necessarily taxpayer friendly as compared to some other states that we deal with. But I would say in this case, in the VDA program, I've had a lot of success with their staff in that model. They're quick to respond. It's a fairly easy process. There's some documentation has to be completed, and it happens fairly quickly. And I keep iterating quickly, and that's because there are some states out there where it could be 6 to 9 months before you hear anything back once you start the VDA program. So Chicago is pretty effective in that regard. But yeah, they do have a program, formal program.
Great.
The next 2 slides is really about compliance. You know, you've kind of established that Nexus exists and that you've got some taxability. So what do we do next? And we talked about those 3 options. Do we register and comply prospectively? Do we do a VDA, or do we do something in between? The next 2 slides really are just focused on some of the things you just need to understand and know as you start down the path of compliance. So we'll just assume we're going to get registered and start complying prospectively. And these are some of the categories or things that you probably need to know the answers to before you start the application process. We already talked about some of the questions on the application that would require when Nexus was established. Materiality, taxability. There's usually a question on the form that asks what your expected tax exposure is going to be, or tax liability, I should call it, is going to be prospectively. That might engage the state to give you a lesser filing frequency. The more tax you have in the way of liability, the more frequent your filing requirements. You do have to take into consideration whether or not your products are going to be sold to companies or individuals that have exemptions that require certificates. Are you prepared for that? And are you prepared to manage through that? That in and of itself could be an entire presentation. So we talked about the registration. Don't lose sight of some of the local registration requirements. The question about Chicago is on target in that regard. You heard me talk about Alaska earlier. Colorado and Alabama and Louisiana also have local what we call home rule jurisdiction compliance activities that they administer. So there's some complexity there. It's also important you understand the tax type. You know, we've talked about sales tax primarily, and you heard the term sales and use tax. Two different tax types and have two different applications. Usually it's the same rate, the same amount, but there are other tax types that are transaction-based, and there's a number of things to consider when you're registering to make sure you're registering for the right tax type. You're going to have to provide an officer's Social Security number. It's just inevitable with any of the requirements. And you really need to think ahead, how am I going to get tax on the invoice, and how is that tax going to get from the invoice to my GL, from my GL to the sales tax return, and then get paid. There's a whole host of services and software applications that can support all of those. TaxConnex obviously is one of those solutions that can help from the beginning to the end.
Platforms like Shopify collect sales tax, but they don't remit. If not, can you recommend a platform that collects and remits? I think what you're probably struggling with, and maybe the contrast, is a marketplace facilitator versus a technology platform. So really what Shopify is a technology platform that helps, as you're describing, to facilitate the charging and the collection of the sales tax, and then the remittance piece is left to the taxpayer. Personally, we have quite a few clients that utilize Shopify and other shopping carts to administer the sales tax from a calculation perspective, but then we do the filing and remittance. The marketplace facilitators, and typically you're looking at, like an Amazon or what an Etsy, eBay, become marketplace facilitators, where they are responsible for the collection and the remittance of the sales tax. So if you're a business that sells purely 100% on Amazon, for the most part, you have no sales tax issues to worry about, because as the marketplace facilitator, they take care of that for you. So you're probably looking for, potentially selling on a platform that would consider themselves a marketplace facilitator. So I'll save the rest of the questions for the end, and then we can get into some of these updates for the audience.
So in terms of these updates, we're just going to walk through some things that we felt like were of interest to a broad audience. These are not intended to represent all of the updates that occurred in 2024 or that will occur in 2025. It is very much a subset, a small fraction of all the different rules and changes that are happening in legislation. But some of these you may find interesting depending on your business activities. Some are not going to apply to you at all. So I'm going to kind of talk through them fairly quickly, and then if there are questions or concerns about any of these in particular, let us know. maybe in the comments or otherwise, and we can follow up with you on a more detailed basis to talk through it. Kind of going to go in alphabetical order here, with Alabama having sort of a statement that says, look, if you're going to buy certain types of medical equipment, which in the past may have been statutorily excluded or exempted from tax, you now have to be able to supply an exemption certificate for that equipment. Most of the states have varying degrees of exemptions that apply to certain medical devices and equipment. And in some cases, in a lot of cases, it's statutorily exempt, meaning that by mere mention of it in the statute, you don't have to charge tax. You don't need to validate that exemption with any type of a certificate. But here's an example where, effective in September of this year, Alabama is requiring some degree of exemption certificate at the time of purchase to exempt that. Delaware. Now, you might be asking, why the heck did Jeff put Delaware on the list when he just told us Delaware doesn't have a state sales tax? Well, it happens that Delaware, as well as a few of these other states I mentioned earlier, they do have some unique transaction taxes that can be employed or deployed by the legislature. Here's an example of something that's more recently been introduced, and that is a short-term rental lodging tax. And again, there's some uniqueness here. Does it apply to hotels or just merely to bed and breakfast type facilities or VRBO or Airbnb? These are things that, when they're enacted, tend to catch people by surprise. We see these types of taxes impact companies in Florida significantly. It's some long-standing law, but it's a big issue down there. So we just wanted to highlight it for you because it's not something you otherwise would have heard about, more likely than not. DC has decided they're going to increase their sales and use tax rate next year and then increase it again the following year. Fairly unusual. It's not very frequent that we see jurisdictions change their rates. At least, again, going back to what I said earlier, we kind of treat DC as a state. So I'd call this a state level tax change, rate change. So that's fairly significant in regards to what we're used to seeing. In Georgia, something a little bit interesting. They're doing something to try to offset some property tax reform law that's gone into place and to give local jurisdictions, in this case primarily counties within the state of Georgia, an ability to increase that sales tax rate on transactions to offset some of the state level property tax impacts that are coming down the pike. Illinois, a couple of things here. The first of which is probably most significant. Illinois is going to repeal the state grocery tax, which is really not that huge a deal because it's a 1% rate. So it wasn't overly significant. Certain food products qualify for that rate, by the way. Not everything that you might consider a grocery qualifies for the grocery tax reduced rate. So it's important to kind of drill down into the details of that. There was also a amendment to some telecom provisions relating to the prepaid wireless 911 surcharge. And that took effect in August of this year. And there is a 3% statewide surcharge that will no longer apply to sales of certain prepaid wireless communications in certain jurisdictions, in this case, primarily Chicago. So one of the things we haven't talked about yet is telecommunications, and not to go into that in a great deal of detail, but it is one of the service elements that's heavily taxed and taxed at multiple levels, meaning it's taxed at the state level, county, city, and even municipal, local police jurisdictions that might be subsets of a city, districts as we like to call them. A lot of different tax types in the telecommunications world, and it's onerous, frankly, the level of compliance those companies are required to execute. Here we get back to something we've talked about 2 or 3 times today in Indiana, and I'll go ahead and skip down to Wyoming and North Carolina. All 3 of those states are eliminating the economic nexus threshold relative to transactions. So they're still going to have the revenue threshold, and in all three of those states, it's $100,000, but they're no longer going to have that 200 transaction threshold. That's going away. So we're kind of happy about that.
And Jeff, on that same line, earlier in the year, there were a number of states that repealed that transaction count threshold as well. I don't have a complete list in front of me, but I know some of them were California, Colorado, South Dakota, North Dakota. They all repealed these, and that's where we were referencing before. I think you're going to see more of this going into 2025. Throughout the year, I think you're going to see more of those get repealed.
Yeah, I agree. New Jersey is eliminating sales tax holidays. So if your business model is predicated on taking advantage of sales tax holidays, a lot of times this has to do with school and purchases of school materials and clothing. And they're also eliminating an exemption that existed for zero emission vehicles. So kind of backtracking on some of the e-vehicle type exemptions that were applicable or in place previously. Oklahoma is eliminating the tax essentially on all grocery items. And it is probably, I believe it's already in effect. I think it went into effect in the spring of 2024, but it's a pretty significant exemption, and that was passed and signed by the governor in early part of 2024. This one's interesting, a little bit interesting to us in particular, but Tennessee is doing a study of cost of vendors for collecting tax. And as we've talked about or touched on a little bit, as vendors that are charging and collecting and remitting this tax, we're acting as agents on behalf of the states. And in some states, the states will provide you with a percentage of that tax collected as what they call a vendor's compensation. And I think different states approach this differently and have different degrees of vendor's compensation percentages. Some don't have them at all. But I think it's enlightening and positive to know that Tennessee's evaluating that and looking at it. And lastly, again, to Elon Musk's displeasure maybe, Wisconsin is enacting an EV charging tax of 3 cents per kilowatt, and the sales tax exemption for certain electrical vehicles. So there's a lot of stuff going on both ways in terms of directional exemptions and that are applicable to electronic vehicles and some that aren't so applicable or valuable. Thanks, everyone.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.